everybody needs to be realistic in terms of what's possible. I think that it's difficult to raise money and say this is going to be my portfolio strategy, but if I don't raise exactly what I want to raise, I'm going to throw that out the window. It's better to think about what is your minimum viable fund size. So again, if it's 15 million versus 25 million, what is my portfolio construction going to be in under both scenarios? Like in the latter scenario, maybe it's, where I raise 25, maybe a few more companies, maybe slightly bigger initial checks, maybe reserves change on the margin, but it doesn't go from I'm doing 50% reserves to 0 reserves, because that fundamentally is a difference in business model that as an early limited partner, you're going to look at and say you drifted from what you actually told me. So I think there's things on the margin, yes, and we have to think about minimum viable fund size. And today, can't be aggressive. You can't be too aggressive. Everyone's struggling. Fundraising will take 12 to 18 months if you're a first-time manager raising any type of significant capital, and that's okay.
Superclusters is the podcast to demystify the secrets, stories, and tactics behind the money that moves the venture capital world.
Samir Kaji is the CEO and co-founder of Allocate, a platform to make investing in venture capital simpler and more efficient. Prior to Allocate, Samir served as the managing director for both First Republic Bank and Silicon Valley Bank, which I know both is a story for the grandchildren, as many of our viewers and listeners know as well. He has also written multiple individual LP checks into some of the most recognizable brands today, including the likes of Lux Capital, Bullpen, Parade, Array, and more. And as if all the above were not enough, he runs one of my favorite podcasts on venture, and aptly named Venture Unlocked, which at the time of this recording is well over 110 episodes. And that, my friends, is more Dalmatians in the 1961 Disney animation. Samir, welcome.
Thanks for having me, David.
There's so many places we can start, but before I get into, I want to preface that my gateway drug into the Samir Kaji cinematic universe was actually not where you'd expect. It wasn't Adventure Unlocked, it wasn't Allocate. Even though I learned about you as an individual back in 2021, it was up from a friend, actually, who I'm not sure if they knew you personally, but I wanted to learn, and when I told them I wanted to learn more about the LP universe, they said, you've got to check out Samir Kaji's Master List of Micro VCs. And if you remember, that was a Medium blog post he put out a while back, I believe in 2019. And if you remember, of the many free stories in which you do write, this was one of the few that required a Medium membership. And I didn't have one at the time. And I thought, who the hell makes a list designed to make venture more accessible, less accessible? That said, you were the one reason, I haven't told anyone else this, but you were the one reason I ended up signing up for a Medium membership. And had there been an affiliate marketing program for Medium, you would have gotten your check in the mail. So I just want to say thank you for that.
Well, thank you, Medium, for the extra business. So you're welcome.
And so, as I mentioned, there are many places we can start, but maybe we can start somewhere to set the stage a little bit for the LP world where we're at right now. So, Samir, you've been around the LP block for a while, from your time, as I mentioned, at SVB during the dot-com era to your relentless focus on VC and private equity at First Republic, to now creating something truly special at Allocate. A lot of our listeners, and I'm going to put myself in this bucket as well, are Silicon Valley natives or super fans of venture as an asset class and have seen the ins and outs of quite a bit. But we also move fast and break things. We live in Silicon Valley. We both grew up in Silicon Valley as well. It's all about disruption. And for someone who's seen everything in the private markets and for the better part of a score of years or so, has admitted the VC and LP ecosystem is ripe for disruption. I'm actually curious what aspects of the LP world are actually ripe for disruption. And to scratch my own itch here, are there elements, or what are elements where legacy and the tried and true methods are here to stay?
Yeah, well, why don't I provide a little bit of context, because you provided some background, and it does tie into some of my thoughts in terms of where the LP universe is right now. So if you look at venture, historically, which now is about 50, 60 years, in terms of it really being an institutional asset class, I started in the early 2000s. VC was effectively a monolith, right? So everyone kind of did the same thing. You had four partners around the table, typically investing across different sectors. And it wasn't like what we see right now, which is number of specialists, a lot of fragmentation. Starting around 2008, 2009, and actually during the last dislocation that we saw from a macro standpoint, what ended up happening is we saw mobile and cloud really happened. And that created this new universe of companies and this Cambrian explosion of companies. But it also transformed venture because now you didn't, as a company at the early stage, you didn't have to buy a bunch of servers to get off the ground. And the cost of capital to get a product to market was so much lower. And now, because everyone had a smartphone in their pockets, like you could distribute the technology. And that's when technology started to affect every industry sector, right? Fintech became a thing. Of course, there was tried and true like bio. And then you probably remember the social, local, mobile wave. And all of it was because of the fact that it was cheaper to start a company. At that around the early 2010s, we started to see this new class of VCs come into play, right? So the emerging managers, people that were investing in seed. Over time, that became people that were geo specialists or sector specialists. And as you've kind of seen over the last 10 years or so, that list I've posted, obviously very stale now, but there's been about, close to 3,000 active VC firms that have been formed since the GFC. So as an LP, there's been a few frictional barriers. It's like, how do you find the right VCs? Like, how do you make, make an assessment on one versus another? And then for the big institutional LPs, it was a check sizing issue, i.e., to write a check into a small $50 million fund may not even work if you have to write $20 or $30 million checks. So starting in 2013, what I really saw, the biggest shift in the LP world was more non-institutionals allocating to alternative assets, and venture became a big part of it. Some was driven by the fact that there was nowhere to put money, right? So there was no interest rate to be had on things like treasuries, fixed income had gone away. And people were looking at things like private equity and venture as a way to get some alpha. And so over the last 10 years, we've seen the private LP markets, so emerging LPs, become a bigger and bigger part of the world. So high net worth individuals, family offices, writing smaller checks, AngelList also created, and a lot of credit to them, for essentially allowing people to participate at the venture level by writing smaller checks and having a discovery engine. And so the biggest thing that we're seeing right now from a secular standpoint is the world of private wealth right now in terms of assets under management is equivalent to the assets under management by institutions. The difference is institutions are largely over allocated or fully allocated to things like venture, while the average high net worth investor is sub 1% in VC. So a lot of room to run. And what we're seeing now is the increased democratization of asset classes, including venture capital, to the high net worth sector. Still in the early stages, but it's happening. And over the next 10 years, I believe we'll see the biggest transformation in how private markets operate: more efficient, more transparent, more accessible, and more liquid. But to answer your question, it's more individual LPs.
More individual LPs. That makes a lot of sense. And as we kind of like navigate that world of individual LPs, kind of looking to allocate more into venture funds, because our audience is largely of emerging LPs, how do you recommend people as writing their first few checks into venture funds? How do they think about like net worth as a function of check sizes, as a function of like how much they should be putting into venture?
Yeah, I mean, and it's going to depend on your personal situation. But number one is if you're an accredited investor, you may not be able to invest in certain type of funds that require something called a qualified purchaser status. That simply means you have to have at least $5 million in net worth to be able to access these QP only funds. But let's just put that aside for a second and take that question very simply and say, how should I be thinking about venture as an asset category as part of my overall portfolio allocation? So the first thing is understanding your risk component, your liquidity considerations, and what you're trying to achieve. I always ask emerging LPs, why venture? Like, why do you want to do venture? And the answers, range from, I want to get great returns to, I just want to learn. I want to really learn about, companies that are transforming the world. And I can have 10% of my portfolio be risk capital. So usually, unlike an institution, people aren't dogmatic and say, I have to have at least 15% or 5% or 20%. It's more around, what are you comfortable and what are your financial goals? If you've seen some of the reports, 5 to 15% is pretty standard for a family office to put into venture capital. And it's grown over time. It used to be like 3%. Now it's an average of about 11%. When you think about that, though, that is a multi-year thing. So it's not like I've $10 million, hypothetically. Let's not saying I do, but let's say I did have $10 million, and I want to do 10% in venture. I'm not going to write $1 million check to a single fund. I'm going to look to deploy $1 million maybe over 2 or 3 years, and then ultimately pick a variety of managers that create a nice portfolio for me. Now, historically, that's been hard because the minimum check sizes have been so big for a lot of these funds. And so you're almost forced to write a bigger check that comes at the expense of healthy portfolio construction. Now, that's changing with companies like ours, which miniaturize the check sizes that people write and unlocks access into some of the top firms. But, as I looked at my own personal investing, I kind of went through this normal path of dabbling at first. I had no plan. I just wrote a bunch of checks to people I liked. And then over time, I said, holy shit, I got to figure out something that's a little bit more programmatic to be smart about how I allocate to VC and PE. I've invested in about 60 funds so far over the last 10 years. And, now it is very much the institutional style of investing. But, when you start, you really have to just assess your own personal needs and what are you trying to achieve before you start writing checks. And I do think that you have to meet a lot of managers before you write your first one, especially if you're just getting started, to be able to make the right amount of judgment and juxtapose a lot of different strategies. After a certain period, everyone sounds the same, but at the beginning, everyone sounds great.
That's fascinating. And just make sure my I might be shooting myself in the foot, but my dyslexic ears have heard you right. Did you say 60, like 60 venture funds to date? Okay, I want to touch on that. You mentioned that in the beginning you wrote checks into people that you liked, and over time you became more programmatic about how you deployed it. If you could, obviously, as I mentioned earlier, you've invested in some great firms, including Lux, Bullpen, Parade. I love freaking Sean at Parade, and so many different other ones that are just phenomenal, have done phenomenally well. How's your calculus for investing in a GP evolved from your first check as an LP to maybe like your 60th check today?
Yeah, early on, it was simply a function of, who do I like? Who do I think has some type of characteristics that are going to drive returns? And candidly, who would take my check at the small sizes I was writing at the time? And I was writing LP checks that were 25 to 50,000 to start. These were tiny, tiny checks. And over time, as I got a little bit more institutional in my thinking, it was more around, I would pick a manager. Now I pick managers based on what fits my overall portfolio. I look at my cash flow considerations. I look at what I already have in the portfolio. If I've done 3 fintech funds, unlikely, even if I like the person, I'm going to do another fintech fund because then I'm overexposed. So because it went from one-off, very opportunistic, ad hoc investing to now being a portfolio manager. And, fortunately, I started investing in 2012 and 2013, personally, where I wasn't conflicted out by my work at First Republic. It worked out well. It was a great environment to invest. It was a perfect time. So I, fortunately did, fairly well in the investments. Now it's just a little bit more thoughtful. And I also do private equity and, private credit. So it is this entire alternatives architecture that I use for our family office.
To make this a little bit more concrete, and you don't have to mention any names, you mentioned you were still writing like 25, 50K checks, which are honestly the size of a lot of angel checks that people are writing these days. How did you convince the first fund manager you wanted to write into, like, to take your 25, 50K check? And what was that process like? How did you get to conviction yourself? Like, I like this person, but did you have the thought of like, would this person be good fiduciary? Or was it just like, you thought this person was really smart and you'd like to invest in them? Like, could you walk us through some of the play-by-play of your first investment? It doesn't have to be first, could be second.
Yeah, the first investment, candidly, was it was a first-time fund. And by the way, all I was doing is fund ones and fund twos. So easier to get into a fund one or fund two when, at the time, even then, it was tough to raise. This is right after the GFC. There was a lot of capital that was still coming off the sidelines and starting to invest in GPs, but it was still pretty tough for a lot of people. Ultimately, for me, it was people that I just had a good connection with. And I felt they were similar to me that I could see myself building a 5, 10, 15, 20-year relationship with. And then ultimately looking at how they thought about things. So I think there's some things like that are table stakes, like portfolio construction, how you help companies find, like, if you don't have those things, then you probably shouldn't be running a firm and, raising a fund. But ultimately it was indexing on certain characteristics. For me, it's like, do you have a chip on your shoulder? Are you self-aware? And when you have those things, it's just this unique sort of intersection between ambition and awareness of where they fit into the overall ecosystem. Not trying to play in a game that they can't win, but understanding what they're uniquely qualified at, where they have an asymmetric edge. So if it's somebody like, hey, I think, back then I want to do clean tech because I heard it's great, and I want to raise $250 million because an institutional LP told me that I need to raise that for them to even consider it. To me, that's not self-aware. That doesn't make any sense. But the folks that I, met, in fact, one of the first GPs that I did invest in was Bullpen Capital. Their first fund was, really small fund. It was sub $20 million. And there were, these three guys that, felt and looked very different from everyone else. Paul Martino from Philadelphia, Duncan and his partner Rich were here in Menlo Park. And they just had this, dynamic between them that you knew there was going to be plenty of civil discourse. They were looking at areas that no one else cared about. And they said, hey, like, we just like funky things that are just different. And just hearing them talk made it very clear they knew who they were. And if you ever met Paul or talked to Paul, the guy's an animal, and he has this unbridled enthusiasm and ambition of building really interesting things. So those two things, again, hustle and self-awareness.
I want to touch on something because you mentioned the first couple of funds you see, everything looks very unique, everything looks special. But over time, you start seeing that things are of the same. And there are two questions I want to follow up here. One is, for someone who hasn't seen nearly as many funds as you have, how does one go about thinking what is unique, what is not? What is something that emerging managers may think is unique, or maybe emerging LPs think is unique, but is actually not as unique as they might think it is? Or maybe I'll seed it first. I've seen a lot of co-investors being top tier investors, and almost I don't see any fund that doesn't have top tier co-investors, because you do want to invest in outsiders at the early stage who eventually become insiders. But are there other examples of that? And to seed the second question, are there emerging manager red flags?
Yeah, so there's a lot to obviously unpack there. I'm going to take it at a maybe 30,000 foot level in terms of how I evaluate. And I think over the last 12 years, probably met about 1,400 managers and went through, at least that many pitches. And one of the things that I always look at is GP business model fit. And what that essentially means is, when you think about investing in any fund, you're really looking at three main components. It's sourcing ability. Like, are you seeing the deals that fit within whatever business model that you're executing on? Do you have some acumen for picking? And then the third is, what is your ability to win? Have you proven your ability to win, get into really interesting deals that might have been either oversubscribed or hard to get into? Were you able to do your pro rata in the next round because you added value? And we also look at the lens of, does this person have some kind of asymmetric edge on at least two of those three things? So I don't think you can be a great sourcer, but you can't pick and win. I don't think you can win, but not source and pick. So you have to have at least two of those three. And so what we look at is, what about them or their team allows them to get two of those three at a very, very asymmetric level. So it's not just like, hey, I'm pretty good at it, but why are you going to be a top decile sourcer? Why do you see deals? Picking is really tough for emerging managers, in that assessing that takes, I want to see, 8 to 10 years of performance to know if somebody is a great picker, or they just happen to be in the right rooms, which is okay too. But at the end of the day, in the early, innings of any type of firm, you're just looking at, is there something unique about them that gives them an asymmetric edge in one of those three, or two of those three things? The red flags, there's so many red flags that come up. It's growing fund size too quickly. So when I said GP business model fit, I didn't just mean their thesis. your fund size, as Mike Maples has said so many times, which I agree with, is your business model. So do you have a asymmetric advantage with your overall thesis, and then does it fit the fund size that you're doing? So just because you were successful at a $40 million fund, once you jump up to 150 to 200, you're that fund is playing a very different game. They have to lead checks. They're more likely to compete. Ownership becomes a bigger issue. Who they're competing with is a very different landscape, because you get squeezed by the big funds and then the small funds. So you have to evolve yourself, and your enterprise has to be stronger from picking, sourcing, winning in some way. Either your brand's gotten stronger, maybe you've added a new person, you built something systemic that allows you to scale and compete at that larger, fund size. So fund size growing too fast. When you see a deck with like 6,000 advisors, and you kind of see that, you're just like, okay, well, I don't really see much value unless it's very tangible. I also think that not really understanding portfolio math, which sounds like it doesn't happen, but it happens a lot.
Mm-hmm.
I often ask the question, what is the enterprise value you need to achieve to get to a 3x net? And sometimes I'll get a blank stare, and that of course can't have. You just need to know, how do you build a portfolio in a way where your enterprise value doesn't have to be like $37 billion to be able to get a 3x on a $100 million fund? That shouldn't be the case. That means your ownership is too low, and you need to recast how you build your fund model. But those are some of the main things that I see. I mean, obviously there's a lot of red flags that we talked about, but those are just three of the ones that I think are fairly actionable and easy to address from a GP standpoint.
Not to harp my own horn over here, like Samir, you and I, and as well as a couple other LPs, we put together this blog post last year, the Emerging LP Playbook, which includes a lot more emerging manager red flags that you've additionally shared. So I know we don't want to take like the whole episode just to talk about red flags, but if people are curious, that is an avenue of where people can go to look for more. And you also write, really, I want to say, like, there was a Substack post you also wrote about emerging manager red flags as well, which I highly recommend people to check out. So it's not on Medium anymore, but it's on Substack. So you've switched sides, so to speak. So speaking of questions, I'm actually really curious, because in talking with, I'll just say her initials, CH, who is someone who helped you start Venture Unlocked, and during your time at First Republic. I haven't gotten her permission to share her name, but you can probably guess who I'm alluding to. And she's helped me kind of like with this question, but you have this prolific Rolodex of questions. You also mentioned like asking the right questions to emerging managers in the beginning is really, really important. So I'm actually really curious. In your opinion, what are the mechanics of a well-structured question? And as a follow-up, and I can follow up with this later, but just to seed it, after producing, as I mentioned, over 110 episodes and putting in your 10,000 hours in the content creation space, has there any part of being a podcast host made you a better inquirer for diligencing fund managers?
Definitely has. And there's a couple of reasons why that's the case. So the first thing is, when you are doing a podcast, you have to take a beginner's mentality. So whenever I'm doing a podcast, and I was not actually very good at it. If you listen to my first few episodes, complete train wreck, I had my list of questions. I'd kind of go through them. And over time, what I realized is, a good podcast is one that's very conversational. You have to intently listen to the other person and take the beginner's mindset as if you were a 5-year-old. Remember when you were a 5-year-old, you go out to the park with your mom and you're, why is the sky blue? She gives you an answer, but why, but why, but why? What I've realized is, on the podcast front, some of the best questions are really follow-on questions that just go deeper into somebody's mind and thought process. So when I'm listening to a GP pitch, I'm really looking for those small breadcrumbs that they've said that might be innocuous, but where you can now drill more into. If they say, hey, we really think this, particular sector is going to take off, and here's all the math, I might say, well, is there anything about that math that could be flawed? Is that backward looking? Tell us a little bit more about that. And then you start to see their gears, and you get deeper and deeper in how they think about things. When you're investing in a fund, especially when you're making an ex ante decision, meaning that you're not buying a secondary, you are actually just looking at what is the probability of success in the future. You want to focus on process more than just outcomes in the past. And the process is, how do they think? And I will ask her some really dumb questions, or what seemingly might seem dumb, just to get them to talk, and maybe ask a question that they're not used to. And it may be a question I don't really even care the answer for, but it gives me a sense of how they process information.
I love it. It reminds me of I'm paraphrasing here because I don't remember the exact nomenclature for it. This quote by the poet Allen Ginsberg, where he says, "I'm a poet and it is my job to play the fool." And I think in the world of podcasting or just interviewing in general, it is our job to play the fool, so then our viewers and listeners can get a lot more out of it. And I'm still learning, right? And I'm only a few episodes into recording it, so I've been tuning into tons of your episodes and seeing how you've evolved over the years. And it's just absolutely fascinating. Another thing it reminds me of is, I want to say this was a Neil deGrasse Tyson commencement speech. So I forget when he did it, but there's this really fascinating thing where he was like, "Hey, let's say you're a recruiter, right? And you're looking to hire two different folks. And the question, like, let's say you're in this super tall building, Empire State Building, Salesforce Tower, whatever it is. I forget what the building he was talking about. And he's like, like, the question would be, how tall is the spire? And you have one candidate who goes like, "Hey, you know what? Like, I've memorized every height of every single spire, and I work in architecture and just happen to know the number. It's 155 feet tall." And then the other candidate goes like, "You know what? I actually don't know, but give me a second." So he walks out the door. He looks at his shadow. He measures his own shadow. He measures his own height. Then he measures the shadow of the building itself. And he comes back in, and maybe he doesn't say 155, and he says somewhere around 150. But that person who goes through all the work and like how they think is the person you're more likely to hire than the person who actually had the right answer. And going back to what my sixth grade teacher once told me, like, show your work. And I think that's really important, at least in conversation. Correct me if I'm wrong there, but that sounds like what you were alluding to.
Yeah, it's 100% that. I just want to know how somebody thinks. It's the why. Like, the question about, why are you doing this? Why do you think you're uniquely qualified? I want managers, and I think most LPs want to see this, is managers that have completely stress tested every single assumption they make. Like, when you're inside a business, it's very easy to say, we have this and we have that. When you provide a question that in any way maybe contradicts or goes against that obvious thing, you start to get a sense of, have people really thought about it? Have they thought about the why? Have they thought about all the things that could go wrong? I don't know if it was Charlie Munger or Warren Buffett that had this, but there's this concept of, when you think about building a business, instead of thinking about all what it takes to be successful and all the things that have to go right, you have to think about the reverse, and about, I think it's the inversion technique, where it's, what can go wrong here? Like, why wouldn't this work? And as an entrepreneur, I took that to heart in the early days. Why won't Allocate work? And I like GPs to say, why won't my sourcing work? Why will I be a bad picker? What are all those things? And then you just make sure you create a plan that avoids those things, right? You do things that are opposite of that. And I like when managers can articulate exactly, hey, this is my hypothesis. This is how I'm going to test it. This is why it may not work. And once you get a sense of that, it really helps you understand and get into the mind of somebody, of what kind of investor they're going to be. Doesn't mean that you're going to be right. Like, we don't know, right? We won't know for a very long time. I'd say about 6 or 7 years before we know a fund directionally what quartile it's going to be in. But you're making those decisions on thought process, and you got to really dig into those things.
I'm curious to jump on that, to double click on that thread. I've been seeing a lot of managers have this like toggle thing when they're fundraising, which is probably an example of, like, if I'm not able to raise a $25 million fund and I only raise a $15 million fund, I may not do reserves. Like, before, if I had a $25 million fund, I might do 20% reserves. And there's like this toggle mentality. In your mind, is that a version of hedging their risk of not being able to fundraise? Like, what could go wrong with fundraising? And are there other examples of hedging what could go wrong?
Well, I mean, in today's market, I mean, let's be very clear. I think that this is the hardest fundraise environment we've seen for funds, maybe ever. Even 2009, obviously very difficult, but there wasn't 4,000 people looking for capital, and we weren't. In 2010, we were in a zero rate environment, right? So things have materially changed. So it's very difficult. So everybody needs to be realistic in terms of what's possible. I think that it's difficult to raise money and say this is going to be my portfolio strategy, but if I don't raise exactly what I want to raise, I'm going to throw that out the window. It's better to think about what is your minimum viable fund size. So again, if it's 15 million versus 25 million, what is my portfolio construction going to be in under both scenarios? Like in the latter scenario, maybe it's where I raise 25, maybe a few more companies, maybe slightly bigger initial checks, maybe reserves change on the margin, but it doesn't go from I'm doing 50% reserves to zero reserves, because that fundamentally is a difference in business model that as an early limited partner, you're going to look at and say you drifted from what you actually told me. So I think there's things on the margin, yes, and we have to think about minimum viable fund size. And today, can't be aggressive. You can't be too aggressive. Everyone's struggling. Fundraising will take 12 to 18 months if you're a first time manager raising any type of significant capital, and that's okay.
I'm curious, how do you personally, Samir, define minimum viable fund, and how do you expect like emerging managers, or even like just as LPs are looking to, how do you expect them to define it?
Yeah, I mean, of course, it's going to be a little bit subjective, and it typically isn't an exact number; it's some kind of range. And what you're really looking for is whatever the manager's business model or thesis is, the minimum amount they need to raise to be able to execute with a high level of proficiency. So, let's say I wanted to lead Series seed checks, and let's not pre-seed but seed, and the average seed round is $4 million, leading 1.5 million to 2 million, and I want to do at least 25 companies. I just feel like 25 companies is exactly what I need to do. Well, you can't really have a minimum viable fund size of $15 million, because that wouldn't really allow you to lead those checks, get the ownership, plus have the portfolio diversification. So in that case, you may say, all right, my minimum viable fund size, maybe I lead, but it's $1 million check, and I'm doing $3 million seed rounds, and I want to do 25. So that's 25 times, roughly a million. Let's carve out like fees and fund expenses for a second. And then I want to do some reserves. I think I want to do at least maybe 30% reserves. Now your minimum viable fund size is kind of between 35 and 40 million. And that kind of gives you, this is what I need to execute on this particular strategy. Now, if it was, I don't care if I lead or not, and I'm willing to write a check as low as, 500,000, then your minimum viable fund size is going to be much smaller, where you can still build portfolio diversification. You can still get whatever ownership targets that you're looking at, drive that type of return that you promised to, or at least attempted to, provide LPs, and it'll back into a number that kind of gives you that. It's not going to be perfect, but you still have to have that in your head. So in the case of that 35 to 40, maybe the fund target was 65 million or 70 million, but they're like, at 35 to 40, I can still do it. Smaller check sizes, maybe slightly less in follow-on, but not the eradication of follow-on.
I love it. And I don't want to put words in your mouth, but I'm going to reiterate it to you in like what it sounds like, and then you let me know if I'm actually thinking in the right direction. And you mentioned like the three jobs of a fund manager is sourcing, picking, winning. The minimum viable fund, when you mention the minimum fund you need to execute a strategy at a high level of proficiency, I imagine is the minimum fund size you need to show that you are proficient in at least two of those three: winning, picking, sourcing. Am I right in kind of like understanding it that way?
Yeah, and remember, with going from a fund one to fund two, that could be a 2 to 3 year cycle. So you want to have a fund size that as you raise the fund two, and maybe that fund two is slightly bigger, you can show that you've done certain things. If you're saying, "Oh, I had so much value to my entrepreneurs," well, do you have any sort of examples? It's not going to be TVPI or what your IR is. I really don't care. It's tell me some of the companies that you invested in. Where did you find them? How did you see them? How did you pick them? Did you get, when that company got a Series A term sheet from Sequoia, were you able to maintain or even increase your pro rata? Those are data points that help me understand, has somebody been proficient in a business model that now extends from a fund one to fund two? So it's almost like a seed company raising capital. Well, you want to raise enough where you can show enough proof points to raise that Series A. Here, you have to show enough proof points from fund one to fund two that when you go out and perhaps raise that second fund, that you've done the things necessary in a very compressed time period to evidence that proficiency in two of those three things.
To switch gears just slightly, but to touch on something that you mentioned earlier, you've probably over the past 10, 11 years, you've probably seen like 1,400 like decks, GPs all together. I want to get really tactical for a second. And something that I'm sure our listeners, especially the emerging LPs, can kind of go back home and do a similar exercise, which is there are about 4,000 venture firms today, and I might be wrong on the number, but probably directionally right in terms of just like the magnitude, which is like 100 times more than 05, 06, 07 kind of era. And I'm actually curious, assuming you had perfect information, or as best as you can at least, or maybe you had the decks for everyone in unlimited time, knowing you could only invest in let's say 10, 20 funds, how do you think about breaking down 4,000 funds into maybe 1,000 or 1,400, and then breaking down the 1,000 to 100, 100 to 20? How do you think about that funnel process, about how do you qualify funds at different stages?
Anytime you're evaluating, let's just say at an unlimited time, right? So obviously that very, very hypothetical probably will never happen. But assuming I had time to meet 4,000 different managers, look at their decks, within 30 minutes, usually within the first 10 minutes, I have a pretty good understanding if it's somebody that I think that has some level of asymmetry or knows the why. That's immediately going to probably weed out a couple thousand people. And it's the other 2,000 that now becomes a little harder. So how do you go from 2,000 to 1,000? Then it's really, asking those, what I would consider directional questions that get into sort of the overall process and mental models the manager is using, and assessing, is this somebody that has really thought about things? Do they have this continuous learning, trait that is coming through of how they've applied different experiments on their hypothesis, how they learn from those? And from there, I can probably get it down to about 500. And then of those 500 that I'm looking at, then you're really going to do the technical understanding of what is really asymmetric about what they're doing. And at that point, think about, I don't know if you play blackjack, but blackjack is, a game of both chance, but there is a level of skill component that you can add in there. What type of table do you go into that increases your probability of winning? Do you know what the math is, right? Do you know by the book math that helps you slightly? Doesn't mean you're going to win. It helps you slightly. And then finally, if you're able to count cards, it increases your probability. So what you're starting to really assess with these GPs is what is their, corollary or analogy to counting cards? Do they have something that's very clear? And from there, you can go probably from 500 to maybe 50 to 100 that have that. And then from there, you're simply looking to build a portfolio of 10 that are very complementary to each other, that give you enough coverage across different types of sectors and stages. And at the end of the day, it's who do you it's a people business at the end of the day, right? You're not showing me your TAM necessary. You're not saying this is my software, this is my traction. There's not any of that, especially with emerging managers. So ultimately, I'm making a bet on the person. I'm using both my rational brain to look at that sourcing, picking, winning, but then it's just the overall feel of, does this person have sort of this unique drive in them that they want to create a 20, 30, 40, 50-year firm, not just raise a fund because it seems like a fun thing to do to back entrepreneurs.
I love it. So in terms of building a legacy and not having it just be a 10-year relationship for a one fund, or maybe even a 3-fund relationship is give or take 20, 25 years or so, right?
That's 20 years.
And I'm actually really curious. You mentioned something where you said you want to, for the 10 that you end up picking, you want them to be complementary to each other. Could you elaborate on what you mean by complementary? Is it through diversification? Is it to make sure they're fishing in different pools? Like, what did you mean by complementary?
Yeah, so it was interesting in the early days. I would just write a bunch of checks, and it was here and there, and then I look at the underlying portfolio companies. They're all kind of the same because they were all co-investing. They're all friends, right? So they would co-invest in the same deals. And over time, I said, well, if I really want diversification, and I want to look at the different sectors, I should really understand what they're going to invest in. What arenas, although arena has a very different feel now given the All In podcast. But where are they actually fishing, and what are they trying to achieve? And I'm not ever going to get perfect diversification; it's impossible. You will always get some crossover, but I'm looking to eliminate the amount of crossover I get because I don't want to say take single company risk across all of my managers. So I'm just looking for things that are a little bit orthogonal in nature. And, I do believe highly into, should I invest in a manager that's focusing in a certain region, maybe that's not California and New York? Should I invest in a manager that might be underrepresented, that might have this proclivity to invest in underrepresented entrepreneurs that other managers can't see or unwilling to move past their maybe unconscious biases? So when you look at that, you're actually creating a well balanced portfolio that you don't actually trade off diversification for return. And that's served me very well in terms of building my own portfolio over time. And it's something that as you say, go from 4,000 to 10. That's what I'm really looking for.
That makes sense. And this is a useful exercise to kind of go through for a lot of folks. And there's a lot of ways you can access, obviously, venture funds. Allocate, you can talk to a bunch of friends. You can, ask people, reach out to yourself. I think if you raise your hand and you say you're an LP, you're naturally just going to have people pitching to you. It's the equivalent of if you say you're an angel investor, you're naturally just going to have startups pitching to you, which I understand most people don't call themselves an LP, and because of that, it's a very opaque industry because you don't know who's who and where they are all at. I mentioned Allocate, and I'd be remiss in this episode not to even talk about Allocate. So I want to rewind into the kind of like the archives for Allocate, like rewinding back to like 2021 when you were pitching Allocate. From selling baseball cards when you were a kid to selling vacuum cleaners at Sears for your first job. How formative were your early years as a salesman in pitching Allocate to your investors?
Well, I mean, I think sales is probably one of the most important things you have to learn. I don't care. It doesn't matter if you're an entrepreneur or GP. If you're an entrepreneur, you're always selling to potential customers, to, prospective employees, to partners, right? So you always have to be able to deliver a vision that is compelling. GP is the same thing because it is a people business. So for me, sales has always been part, but I view sales in a very different way. I'm not looking to pitch anything I don't believe in. Second, I look at, when you are selling to somebody, you are selling to the human being. So many people make the mistake of going straight to the rational brain without thinking about what appeals to the emotional side of them. And the only way you know that is actually by figuring out what they care about. So this is maybe a little bit prescriptive now for GPs as well. But so many GPs will go into a meeting and start pitching their fund. Let me tell you my track record. IR is 29%, and I've done this. But they don't know me, and they don't know what they're selling to. So for me, getting to know people, asking a lot of questions, listening to who they are, helped me synthesize exactly around how do you offer something that's going to resonate with somebody that is bespoke to the conversation I've had. And so that really helped me in the early days. As you mentioned, Allocate was started in July of 2021. We've raised a total of 33.5 million really to drive this vision. But a lot of people could have said, hey, who's this guy that was a 20-year banker now trying to be an entrepreneur? Why? But, all the things that I've said throughout this podcast, we stress tested and asked the same question, like, why us? Why should we even do this? Well, why would anybody give us money? Like, what are the reasons this will fail? And then from there, we were able to look inward to be able to come up with a very compelling story that made sense, that was authentic to us. And I think authenticity as a salesperson is something that takes time because you have to realize what's right for you. But once you get that, it can be a very powerful trait in building any type of business.
I'm actually, if you're open to sharing it, and if this doesn't work, I'll take responsibility for it and we can edit this out. But when you were pitching Allocate, what was the part that of the pitch that you thought to yourself was the most authentic version of the pitch?
Yeah, I mean, the most authentic version, and just kind of going back at FRB, I was acting in many ways as this connective tissue in my team was between GPs and LPs. I really liked connecting people to make it more efficient for capital formation and for allocators to find these really great managers because they couldn't meet 4,000. They had to meet, a smaller group of them. And so for me, it was just based on this long-term observation that the GP-LP market was this opaque mess. As a GP, it was so hard to raise capital because many times you had to go to the non-institutional market, but who do you go to? How do you find these people? How do you onboard them? For the LPs, we kept on seeing these family offices that were doing these checks into companies or funds. There were a lot of it was adverse selection. It was based on their first degree networks. And we're like, that doesn't make sense. That doesn't feel right. My dad was a real estate entrepreneur. No one gave him a shot in the early days. He was a civil engineer, immigrated from India. People are like, who's this guy trying to do commercial real estate in the 70s in the East? And it's like, didn't look the same, didn't feel the same. So this world of inclusivity and for more people to be able to participate in what I think is the most interesting asset class in the world was really clear to me. And I just saw that the tools, the software, the overall platforms, none of them were really addressed to create more efficiency between the GP LP interface. And the people I was talking to were GPs and they were family offices as part of our first raise. And they're like, Samir, like, I totally get this. And for you, you've been in the center of this for 10 plus years. If anyone's going to do it, you're going to be able to do it. Right. And so it came from a very authentic, like, it just drove me crazy to see how hard it was for GPs and LPs. I'm like, I want to fix this. And I know it can be fixed. I'm going to figure it out. And I was very clear with people. I'm like, anything we say right now in terms of the business model, what we do is probably going to change. But here's the true north for us. This is what it looks like in 10 years if we're successful. Private markets start to operate like public markets when it comes to accessibility, transparency, and liquidity. We're going to build it. We're going to figure out how to do it. We have this embedded marketplace that we've already built of relationships. Now it's a matter of building the right type of solutions, and we're going to learn a lot in the first years. And that really resonated with people because it was very authentic to us, and we were very self-aware in what we could and could not, promise people.
I love it, and there's so much of that, like that part right now that you just mentioned that comes through conversation. Oftentimes, it's like a pitch is really the best when it's not a pitch. When you're not sitting in front of them and you're like, hey, here's 10 minutes worth of me just saying things to your face kind of thing, right? And it sounds like this was a discovery process. And quickly, like these family offices, these GPs are like, I get it. I get the process. I've been through it. I've been on the receiving end of it. I've been on the deploying end of it. I'm curious on the flip side of the spectrum when it comes to selling, which is selling to your future team members. What kind of individuals were you looking for when you were building the current team you have at Allocate?
Yeah, so I wanted people that were really passionate about the industry itself. So people that were okay and self-professed venture nerds, right? They just love the industry. They loved innovation. We call it the innovation sector, right? It's tech and life sciences. People that really enjoyed peering into the future and thinking about, do they want to join a company for a future they believe in versus what the past has given them? And so I really look for those people that, had this burning desire to want to change something for the better. And then, from there, it's just like those common characteristics. I love people that have a little bit of a chip on their shoulder, like were never given a chance, had to prove themselves. I don't care what school they went to. I went to San Jose State for my undergrad, and felt and looked different than a lot of the bankers out there. And so I'm used to that. My dad had a chip on the shoulder. So I've always grown up knowing that people that have slight chip on their shoulders are always going to do things that have grit and hustle, related to. Hard to test, but you can feel it. You can feel how they answer questions, what they've done in the past, what they want to do, how they talk about the business. And, we were very fortunate to, have found a lot of those great people early on that were willing to take massive pay cuts because we had to hire people that had some level of experience and seniority and convince them to come to this startup with so much risk. And remember, this is 2021. And as we got into early 22, the market had already changed. And so I had to just get people excited about we could be the company that transforms how private markets operate. And that was something that you could see where people were leaning in, and others were like, well, how many weeks of vacation? I'm like, okay, well, that's a red flag. That's not going to happen here. We're flexible on PTO and things like that. But at the end of the day, we have one job to do, and we have a very compressed window to be able to execute on it. So
You almost want people. I'm not trying to put words in your mouth, and I do believe in having some element of work-life balance and resting as well. But you almost want folks that even when they're like sleeping or they're showering or they're like on vacation, like they see this one thing and they immediately think, oh, this kind of relates to what I've been working on. And like, even though I do know how to take time off, I'm going to take note of this because then when I go back in office, I've got to share this with my team. It's the folks who are in a way increasing their surface area for luck to stick by just being aware of what's around them and how it can supplement what they are working on.
yeah, and by the way, I would just push back on one thing. So the work-life balance, I think I hate that term. I usually say work-life integration because work-life balance
Okay,
means that these
I
things
stand
are mutually
corrected.
exclusive. At the end of the day, work is part of your overall life, as is family, as is all the things that you do to maybe satiate other parts of your brain, your what satisfies you. For us, like I don't actually feel like I work. I don't count my hours. I don't know how many things I really enjoy it. Yet at the same time, I know it's really important to spend time with my, father, my wife, and I find time. It's not the quantity of time; it's the quality of time. But understanding that, yes, when you're starting a company, there are certain sacrifices you're going to make, and that is going to be the quantity of time that you have to put into a startup. And so, I'm a big fan of people going on vacations, taking care of themselves, taking care of family. But if you feel like it's work and it's not just a part of your overall life, it's probably not the right place for you.
Like a balance between work that you enjoy doing and work that you need to do to continue doing what you enjoy doing. And I don't think work is the right term for it because, like you, a lot of things in which I do, and like recording this podcast or having these conversations, they don't feel like work at all. They feel very enjoyable. I very much look forward to this. You have no idea. I know we like had some rescheduling like before this, but I was like, damn it. I was so excited to talk to Samir today, and obviously our schedules didn't align, and so like I like our recording for context, and I don't think there's going to be a timestamp on this for listeners and viewers, but started at 8 a.m. But I woke up at 6 a.m. so excited about this, and I was like, I can't wait for it. And I was like doing jumping jacks while I was thinking about this. So I don't know, it's just an element of being excited for what you're doing, and it may seem like work to others, but it's very much play to us.
Yeah, and I kind of look at it from the Pareto principle standpoint of 80-20. So 80% of the time I should really just love what I'm doing. It should not feel like work. And yeah, there's the 20%, which I still have in my day, which I don't look forward to, but it's necessary for me to continue the other 80% and hopefully over time get to 90%, right? So I 100% agree. I enjoy in my podcast. I don't feel like it's work. I just enjoy talking to smart people, digging in, and honestly providing really interesting education to the broader ecosystem of people that are just interested in venture in some way.
I I completely agree. And if for folks, and I'm gonna plug your podcast for a second because I've enjoyed it so much. But I will say, and this is free. Like you don't have to sponsor me or anything. This is free ad dollars for you right here. But I really enjoy your episode with Connie Macabella at Kindred. Um, and there's this particular portion of it which is like the three risks that a venture manager takes, which I highly recommend a lot of people to look into. But that's an episode, and then your recent episode, I believe, with Mark Suster, is also a phenomenal episode, and it kind of goes back to a lot of things we mentioned earlier, about pitching and about selling, about the authenticity. And there's one line that Mark said, and I believe it was from his mentor for someone else or something like that, where he says, people don't care how much you know until they know how much you care. And I think that's just part of pitching, whether you're a GP or an LP trying to build a relationship, whether you're a GP or an LP, and whether you're a founder, these are decade, if not multi-decade long relationships. And the least you can do is just try to get to know the other person on the other side of the table outside of just the numbers.
It's hard to even know if you're selling a product that they should buy if you don't know the person.
Yeah.
So I've had discussions with people where they might have wanted to invest in Allocate or something that we've done in the past. And then I talk to them and I hear what they're going through, and I'm like, I honestly don't think this is the right time. I'd love to have you, and I'm not going to tell you no, but at the same time, just kind of given your options, your opportunity costs, what you're going through, is this really right? And you have to care about people because it is a relationship business. Over time, your best clients or customers are the ones that become your best salespeople, not you. And so if you don't take care of people, you don't have this long-term orientation, you're just playing a transaction game. And that transaction game is, I just go and I pitch and my only objective is to get your money, versus building a long-term relationship with you that over time is going to turn into something. I don't know what it's going to be. But if I feel like you and I are of kindred spirits in some way, and I feel that there is going to be a long-term, great personal and professional relationship, I just want to get to know you first. Forget about the business. We'll figure that out later. And I think more people just need to invest in other people. That's why I like to invest in people early, before they've made it. Get to know them. Like, how can I be helpful? People will remember that.
It's the time, as you mentioned, that you're looking for people with chips on their shoulder. Because at that inflection point, they are the most open to inputs and they seek the most inputs. And at some point when they actually become successful, I know that's a nebulous and amorphous term in itself. But when they get to that point, when everyone else is chasing them, they'll remember you because you were the person who supported them when they were at the inflection point, when no one else is willing to look towards their way.
It's exactly right. Now, it takes a little bit of time and effort, but the concept of paying it forward is a very powerful thing, especially in an industry like this, where reputations, are built off doing things that are different than other people. And so that's why when I joined First Republic in 2012, I said, I love working with people that are just starting things. Let's go after and start working with emerging managers. Fund one. And then we spent 2 years thinking about, how do we add value beyond a bank account? Because bank account cares, like it's commodity. Like, yes, you have to have it. It's table stakes. But what do people care about? They care about network. They care about the ability to access really interesting LPs. They care about knowledge. How do we bring those things consistently and create a program around it? And, our first two of our first clients were, Joe Lonsdale, and which now is APC, and then Kirsten Green over at Forerunner. Those are the first two, but at the time they were both in Fund Ones. Now, Kirsten was sub $50 million fund. Obviously, Forerunner has become one of the best, firms out there. And then Formation 8 at the time was a $448 million fund, so a big fund, but at the same time, still so early in its process. And I really enjoy getting it on the ground floor and then being part of that journey and that elevator up with them.
And both have done phenomenally well. People can check their crunch bases, their pitch books. They're just like, you'll see them everywhere, and they've invested in some great businesses as well. They're boots on. Speaking of being boots on the ground, they still are boots on the ground when it comes to understanding what the market looks like. And I wouldn't call them professors by any means, but they are some of the best educators of their respective spaces that are out there. All right. Samir, I want to be cognizant of time, just to come full circle here. And a large part of this podcast is really to paint the humanity behind the world of LPs, because too often people kind of just look at LPs as this lump sum kind of like group of individuals. So in the aspect of that, kind of want us to be a little bit vulnerable for our audience over here. And I have two questions for you as we're rounding this out. One is on the anti-resume, a question I personally really enjoy. And the second I'll follow up with, which is like anti-portfolio of some kinds. So for the first question, most people in the LP landscape, including yourself, you came from First Republic and Silicon Valley Bank and did very well there, tend to have a really good resume. And you can find all the ways they shine on LinkedIn and on their one-pager, but I've always been a fan of the antithesis. And it's something I call the anti-resume. I have one myself that literally highlights all my biggest failures and professional mistakes. And every so often I send it off to folks like, hey, you know what? This is like, there's nothing good on there. Everything is just bad on there in terms of my background, right? So I'm curious, and I'm not saying you have to like, unfurl the rug yourself and lift it all up, but what was a time you made a mistake, a bad professional decision in hindsight?
The reason that that's a tough question to answer is because I made so many of them. And, when people think about careers, overall, like it's not about eliminating mistakes. In fact, you want to make mistakes. Like you have to be comfortable with making mistakes. As I've thought about, my career, I'll give a high level one, which is early in my career, I thought about everything in short term strokes. So if you think about a career as a marathon, I was always focused on winning that next quarter mile. So how fast could I get promoted? How fast could I get that raise, that title? And I started making a bunch of short term decisions that were just really bad. Like I would, I almost left, Silicon Valley Bank in 2004 because I felt like I should have gotten promoted or I should have gotten paid a little bit more. And it was my father actually in a walk that we took. He said, you're going to be defined by your toughest moments, not by when everything's up and to the right. So this is your inflection point. If you run away from this and just take something for the sake of it because you need to satisfy your ego, you're never going to, really have exponential growth in your career. And so it wasn't a mistake. It was a mistake in my thinking. Fortunately, I had a good support system and my dad as an advisor who talked sense into me. But that was a big learning for me as, I went through my career. And fortunately, like, starting about 2006, 7, everything became long-term. What does this look like for the next 10 years? I don't really care about the next 6 months or the next year. It's just, how do I improve myself every single day? And yes, I made a ton of mistakes everywhere, but I would take the mistakes, you own them, you move on from them, you learn from them. And that's part of what I think is a good professional. You're willing to do things that you may fail at. So when I left FRB in 2021 to start Allocate, no guarantee Allocate was going to be successful or will be successful. There's too much story yet to be written, but I was willing to take a risk. And I, regardless of where it goes, which I think we're in a very good place, you have to be willing to make mistakes. I think I've probably made a mistake a day. I joke about this. I'm like, oh, I should have done this. Or yes, I should have thought about that. That's okay. That's part of it. Just don't make the same mistake twice and learn from them.
And there's probably an element where I can rephrase the question in a lot of ways. But at least I like, I don't mean to point out a mistake, but but I think you pointed out well enough. Like this is the framing of one should think about, and it doesn't have to be a visual, obvious mistake, but it could be kind of like a relapse in thinking kind of thing. Okay. Last question, or I guess second to last question, because the last question is like, where do people find you? But have you ever had an investment opportunity that you missed out on? Not because of what you did, but because of what you didn't do.
So yes, I mean, there have been companies that have been sent to me and I didn't, for one reason or another decide to invest. The one I could think of is a company that was at the time was at the Series A level. And I really liked the founder. I met him, thought he was really smart, but I just didn't have the time. Like I didn't spend the time really thinking about it. I was like, this will come and go. I can wait. And I waited. And then he's like, oh, I closed around, maybe next time. And I'm like, oh, God, if I really have conviction on somebody, I got to be more focused on, working on that. And, it made me kind of learn like, hey, if you really have an instinct and you feel high conviction very quickly, move very quickly. Don't overanalyze. Don't go through this paralysis. And because what's going to end up happening, other priorities will take over and you'll miss it. And by the way, that investment today would have probably been about a 45x of my initial investment.
Wow.
And so obviously it was painful and I was going to write a $75,000 check. So obviously from a financial standpoint would have been really nice, especially if it did exit for some amount near there. But, it happens and, you can't regret them. I just learned from them. And now I don't typically miss when I have a high conviction.
It reminds me of, I think this is this tweet that Keith Raboy once put out to the cosmos, which was for one-way door decisions. For one-way door decisions, get to 70% conviction. 50% conviction is not enough, and you probably should do some more homework. Waiting on 90% conviction means you might miss the opportunity window. And so because of that, 70% is all you need to really like get to conviction and make a quick decision. Because oftentimes, and every investor is a LP, GP, you name it kind of thing, is a founder. We're smart people, and we can always convince ourselves into a decision. We can always convince ourselves out of a decision as well. And I think at 70%, in a way, almost prevents you a little bit from second guessing.
Yeah, I mean, look, and whether it's 70%, 60%, 80%, it's somewhere in that realm of getting to 100% conviction is almost impossible, because you're always going to have. There's always risks. There's always doubts you're going to have. There's questions you're going to have. I'm not trying to eliminate those things. I just want to, look at things and say, do I believe enough in this to make a decision quickly? And if I don't, if I get to the point where I have like 10 or 15 unanswered questions, I'm just not going to do the deal. It just doesn't make any sense at some point. But if there's like 3 or 4 open questions that I can live with, fine. Let's move forward. You tend to do much, much better than, trying to figure out a million reasons to say no. It's easy to say no to anything. It really is. Like, you just don't have to do anything. But, in venture, like, of course, you can only lose one extra money on every single investment. And, in this case, I lost the opportunity maybe to get a 30, 40x on an investment, and it happens. But I did have 70% conviction. I just, I was looking for more. And then I ran out of time because I was looking for more, and then I missed it.
Well, not love the missing the opportunity, but I love the transparency and the honesty over here. Samir, we are at time. And as we close out, obviously you're in a bunch of places. People can tune into you on Venture Unlocked. People can find you on Twitter, LinkedIn, Substack. But also, like, there's your email. Out of all the places, if people really wanted to follow up with questions on LP stuff and in general, where's the best place to find you?
Yeah, I mean, the best place, either send me a direct message on LinkedIn or send me an email. I mean, I'll put my email here. It's just samira@allocate.co. And either of those methods are pretty good. I won't give out my text or anything like that, but
home
one
address,
of those,
social security while you're at it.
Right. Exactly, right? You can have everything, my firstborn. But, ultimately it is, I'm fairly easy to find, and I try to be really responsive on both email and, when I get LinkedIn. I'm not always great on LinkedIn, but, certainly I try my best.
Samir, it's been an absolute pleasure. I have so many more questions. As I mentioned, I woke up at 6 a.m. for this conversation. I have so many more questions on top of the ones in which we, quote unquote, had for the agenda. But we'll save that for next time. Samir, I appreciate you. Have a great rest of the day, and thank you.
Thanks, David, for having me. And it's great catching up. And if you want to do a part 2 at any point, you know where to find me.
Hello, Superclusters fans. You've seen the logo at the beginning, and now we're here to address the elephant in the room. And the big question is, how intertwined is Superclusters and Alchemist Accelerator? And the truth is, Superclusters and Alchemist Accelerator are 2 completely separate entities, other than the fact that it is only I, David, your host, who is able to traverse between the multiverses. And so the reason Alchemist is a sponsor for Superclusters is the same reason why I ended up joining Alchemist. And it's for 2 reasons: the team and the product. So let me elaborate a little bit. For the team side, I was doing a bunch of diligence, homework, reference checks before I joined Alchemist, and I stumbled across a story which was between Ravi and an early team member of Alchemist. And for the sake of this story, I'm going to call that person John. So Ravi and John were working late at night because they had a deadline coming up, and as they were about to leave, Ravi found out that John didn't have a place to stay and had been sleeping out of his car the entire time. And the next thing Ravi did literally blew my mind, which was Ravi gave the keys to his place to John and said, "John, you're free to stay here for as long as you want." And I knew instantly that this is the team I wanted to join. This is the culture I wanted to be a part of. The second thing is the product itself. Alchemist has built this really robust product called the Vault, and it is the epitome of Peter Drucker's infamous line, which is, "You cannot manage what you don't measure." And so for the uninitiated, what is Alchemist Accelerator? Alchemist Accelerator is your startup accelerator for companies that monetize from enterprises. And so don't take it just from me. We've backed incredible companies, including names you've heard of: LaunchDarkly, Prevacera, MoEngage, And we're also backed by some incredible LPs and investors, including Coastal Ventures, Mayfield, Salesforce. And now, between you and I can't share any of the numbers. And if I do, our compliance officer, will literally gobble me up for breakfast, lunch, afternoon tea, and dinner. And personally, I'm too young to die. But I will say, the numbers, they're great. Like, they're really great. And so if you're curious and want to get involved in Alchemist and the ecosystem, check out alchemistaccelerator.com/superclusters. And that's superclusters with an S at the beginning and the S at the end. And we'll also include these links in the notes. Hey Superclusters fans, this is David from Post and want to share a few things before you go. If you're tuning in from the YouTube universe, and if you like this episode and if you want to see more of it, consider subscribing. It's free. Let us know down in the comments which LPs you'd want to see next or topics you liked and want to hear more of. If you're tuning in from the audio universe on Spotify, Apple Podcasts, or wherever content finds your ear, and you liked what you heard, give us a follow. And lastly, want to share a quick disclaimer from our legal friends. While I am the head of investor relations at Alchemist Accelerator, and that Alchemist Accelerator is one of our proud sponsors, the views expressed in this episode are for informational purposes only and are solely the views of myself and the guest alone. They are not representative of Alchemist Accelerator. None of the views expressed herein constitute legal, investment, business, or tax advice, and any allusions or references to funds or companies are purely for illustrative purposes only and should not be relied upon as investment recommendations. Consult a professional investment advisor near you prior to making any investment decisions. And that's all from me. See you on the next.